to another themoneyguide.ca podcast. I get a lot of questions about this emailed or commented on the forum, or on the site rather, and I thought it'd be a good topic to address, and that would be the topic of how do I either pay off my credit card debt or how do I lower my interest rate on my credit card. This is a very common problem. Debt's so readily available nowadays, it's easy to get multiple credit cards, especially for young kids in university. They seem to be handing them out like candy. So not only do you get out of university with student loan debt often, you get out of university with credit card debt. And that credit card debt, unlike student loan debt, can attract a fairly high rate of interest. So you might find yourself a couple years out of university, just starting your career. You might not be making very much money. So your credit card is accumulated to a fairly significant amount, considering the interest rate. And now you're starting to make a little bit of money and you'd like to really pay down that balance. And how do you do that? And if you are going to maintain a small balance or just use your credit card for everyday use, how do you get that interest rate down? So first, let me just start by saying, if you can avoid it, it's always best. Maybe not have a credit card, but to at least not maintain a large balance on a card. So you might use it. There's a lot of people I know, or a lot of clients I know, that use their credit cards for air mile purposes. So they put everything on the credit card, accumulate as much air miles as they can, which they can use for flights and other purchases, and it works really well. But they tend to be fairly disciplined, and they do pay off their balances at the end of each month. So don't kid yourself. If you don't have the discipline to use a card like that without accumulating a large balance, I would say it's not worth the added benefit of having these air miles if you don't have the discipline to keep the balance down. So first, how do you pay down a credit card? Well, the answer to that question usually starts with have you properly budgeted out your household expenses, your income and expenses? And this is something that's very simple to do, but most people don't do it. And a lot of people will get to the end of the month being short. And when they're short, they put the difference on a credit card, and that happens month after month after month. And before you know it, you have $3,000 on your credit card. You pay down a little bit, then you have $4,000, $5,000, and then before you know it, you're sitting with a $10,000 balance on your credit card at 18 or 20%, and you're feeling like you're drowning because the minimum payments climbing significantly, or you're just looking at this $20,000 balance and you have no idea how you're going to pay this down. So first thing, start with a monthly budget to get on paper or on a spreadsheet to show yourself exactly how much you're bringing in and how much is going out. And you'll be surprised. Almost every time somebody does this, they're surprised at what the figures look like. So how do you set this up? I would say easiest method, use a spreadsheet. Most people are familiar with spreadsheets. You either have Excel maybe on your computer. If you don't, if you have a Gmail account, a Google account, free account, you can use Google Spreadsheet. And essentially all you're doing, you'll have 12 columns for each month. So you go January to December up top in the column headers, and on the rows to the far left, you're just going to lay out first your income, your monthly income. So it'd be the amount that you receive on a monthly basis after deductions from your paycheck. So let's say you make, after deductions from your paycheck on a monthly basis, you make $5,000. Put $5,000 at the top. Then you list out all your expenses, and you'll have a fair amount of expenses, everything from groceries to insurance to property tax perhaps, gas for the car repairs, childcare expenses. Just list out all your expenses. Now, a little bit of a challenge with this monthly budget exercise is you might have expenses that don't happen on a monthly basis. So property taxes is a good example. That might happen once a year. Or payment of other taxes might happen once a year. You get around to months like Christmas, and you'll have larger Christmas expenses, whatever it might be. In our house, what we do is we budget out those larger months or those larger expenses throughout the year. So what we do, if we know we're going to spend $2,000 at Christmas, I just take $2,000 divided by 12, and we take that amount and we actually put that away in a separate account or a separate envelope, so that we actually have that amount. We don't have to. We don't see it coming all in one shot in December. So you can do it either way, but the idea is that you just get something on paper so you can see visually that you have $5,000 in income coming in, and maybe you have $550 in expenses. So once you do that exercise, you see that you're paying out on a monthly basis, on average anyways, more than you're making. You're short by $500. That $500 is going to come from somewhere. So two choices. $500 comes from somewhere. Comes from debt. Perhaps you have the ability to work some overtime. Perhaps you have the ability to start a side business to make up the difference. But most people, they just put it on debt, and debt will continue to rise. The other smarter option would be to just find the $500 in the budget. So maybe you cut down on some of the times you eat out. Maybe you reduce the amount that you drive to cut down on gas. Whatever it might be. If you can find $500 to squeeze out of the budget to get yourself to a point where you're taking $5,000 in and then $5,000 going out and you're flat. Now the problem with that is you're not leaving anything for savings. You're not leaving anything for debt reduction. So you're pretty much just maintaining, and that's definitely not what we want to do. So there's really only two ways to go. You increase your income or you lower your expenses. Just did a podcast recently on how people make money online. That might be a good one to check out. We just kind of detail all the ways that, or some of the most common ways individuals make money online, and how some of them make a significant amount of money. So you might want to check that out if you think there's something that you could, or something you'd be interested in, make a little bit more money to try to narrow that gap. So once you figure out whether you're going to try to increase your income or lower your expenses and create a little bit of room, let's say you've done that and you've been able to create an extra $700 after all household expenses. So then you know that $700 can go towards the debt. There's a chance that you might want to take some of it, put it away for investing purposes, for RSP purposes. I tend to be of the opinion that if you have any extra leftover cash that you want to put towards something like investing or debt reduction, is that you just hit the debt right away. There's nothing like being debt free. Most people don't know what that's like. We're so used to being riddled with debt, but there's quite a liberty and freedom to knowing that you don't have a lot of credit card debt and you don't have a big line of credit. Most people will have a fairly sizable mortgage, and I think that's probably okay as long as you don't over leverage your house. But if you can really reduce the amount of consumer debt you have, it's really going to change your outlook on how you spend your money, and at the end of the day, especially considering the rates on credit cards, you'll find yourself in a much healthier financial situation. So $700 a month extra left over. So you say to yourself, I got $20,000 on my line, on my credit card, $700 a month. It's going to take me a fair amount of time to pay off $20,000. And in a lot of cases, there's not much you can do about that. That's just the way it is. It's easier to rack up $20,000 than it is to pay it off. But at the end of the day, you have to make a decision whether you're comfortable living with $20,000 in credit card debt, or you want to do something about it. And that's where you maybe go back to, if you can't cut more expenses, maybe you try to find some work on the side, extra job, night job, just to get it out of the way. And once you get that debt paid off, guarantee you're not going to want to go back to that same situation where you're $20,000 deep in credit card debt. Now, the other thing you can choose to do, or help you along in the process, is get that credit card rate reduced from 20% to as low as you can get it, essentially. So there's a couple strategies that you can use to get the rate down. I remember when I just finished college, I had a credit card. I had an RBC credit card, and I got a call from CIBC offering me another credit card, and they had a lower introductory rate, and I had a fairly good credit rating at that point, because I always paid my my payments on time, even though I had a balance. So they were offering, I think they were offering 11%, where my CIBC was offering 11%, where RBC my credit card was at 21% at that point. So all I really did, I didn't necessarily need to switch or want to switch. I just called up RBC. I told them that CIBC offered me 11%, and almost immediately on the phone they dropped my rate from 21 down to 11 right there. So I saved 10%, within a couple minutes, no hassle. Now that only really worked because my credit rating was fairly strong. Excuse me, it was fairly strong, and I didn't miss any payments over the last couple of years. So if you're in that situation where you're very regular on your payments, that might be an option. Call up your credit card company. Say you've been shopping around, you're finding some lower rates out there, and just see if they'll just drop the rate for you. It's unlikely you'll get below 10% on any credit card, but it's worth having that conversation. There's a fair amount of competition out there, so it is likely that if they, if you've been a good customer, they'll oblige you with lowering that rate. The other option, which I think is probably the better option, is to try to just secure a line of credit with either your bank or another bank. I mean, the lines of credit are often going to be posted at a couple points above prime. So instead of your 18% or even 11%, you might be able to get a line of credit for 5-6%, which is really going to help in paying down that loan. You're going to find the interest is not going to accumulate as quickly, obviously, and just a much better way to hold debt if you have to hold debt. So those are maybe the two main ways to get your credit rate, your interest rate lowered on your line of credit. So really, that's maybe the two-pronged approach. Free up some room in your budget, create some extra cash flow, use that to pay down the debt. If you can, get the rate down. But at the end of the day, there's no magic bullet. You're just gonna have to hustle to get a little bit more money in the door or less going out the door, and pay down that debt. Now, once it's paid down, the key is not to make the same mistakes. It's easy to overspend. We're in an environment where it's very easy to put a $5,000 TV on a credit card. It's very easy to put a new laptop on a credit card, or justify to ourselves why we need a new laptop for school, or why we need a new laptop for the family, or why we need that new 60-inch TV, whatever it may be. But at the end of the day, if you don't have the money to pay for it, it's got to come from somewhere. And that short-term pleasure of opening up that new purchase is going to fade quite quickly when you start receiving those credit card monthly statements and seeing how much debt you're actually in. And if you really want to stand out from the crowd, being that individual with no debt is going to make a world of difference, especially coming into middle age and into retirement, where you're not going to want to have that kind of debt. You're going to want to have extra cash flow to put towards RSPs, which we'll talk about in a later podcast. You're going to want extra money to put away to your kids' education. So get that debt cleared up early, get it out of the way, develop good habits in saving and not incurring that debt, and you'll be a lot better for it. So that's it for today. Please leave a comment below if you want to chat about what we just talked about. Check out our YouTube page, which I'll put a link in the post box here. I'll try to upload the podcast to the YouTube page as well. If you could add a rate the iTunes podcast if you have a chance. I'd really appreciate that. And check back soon for the next podcast. Thanks for listening.